Nothing we say is investment advice. Please pause on all 3 pages of this disclaimer and read it. Hey, this is Nick Petruzzello. It's about 6:30 p.m. EST on Wednesday, and I was just chatting with Larry here before we got started. This is the Trading Markets and Crypto Zoom call. It's every other Wednesday. So, look, a lot of people are concerned that AI is going to take their job, and I think those concerns might be true, but I think they're not as bad as what people think, or it's not going to happen as soon as what you think. But by the time it does happen, I think one of the last things to go is going to be markets and trading. The problem is that by the time you need to know how to do that, it's already too late, because it takes most people 4 years to become profitable in the kind of trading that we do. So Larry works with me, Larry who's here right now, works with me over at Algo Factory, one of my clients there. And we trade really anything. We trade currencies, cryptocurrency. We have guys that trade stocks. And a lot of it is like day trading. We do talk about long-term investment. A lot of the information that we bring to the table has actually made a lot of people rich, even though we don't give investment advice. They just use it as part of their own research. In fact, Algo Factory has been around since 2023, and V and I, the two who own it, have been doing our thing since about 2016. So we do have a long history of being right about a lot of things. Not always right, though, but really right about a lot of things. That said, we're here to talk today about anything trading, markets, or crypto, whether it's the stock market, bonds, geopolitics, and how it might affect the market. Larry, you're more on the technical investing side of things, right? So you're going to be in the bucket of people who are going to ask really technical questions. So if you're watching this and you're new to trading, just try to be a sponge with our talk today. Don't try to understand it all unless you already do. Don't let it chase you away. In fact, Larry, you've been doing pretty well. You just qualified for a prop firm. I know that particular qualification, didn't work out, but you did fund, and you're on the way to funding another one. So, how's the most recent funding going for you?
Staying consistent with it. I am working through the challenge like I did the first time.
Okay.
So it's working out really well. The psychology portion of it is where I have to pay attention, and then also making sure that I'm not looking specifically at the market for what I want it to do, but for what it's actually doing. So if it's in chop, understand how that affects my algorithm.
Oh yeah. Yeah, that's really key. Give me a second here. Stand by. Got to fix the screen. All right, hold on. So we'll just leave it like it is. That's an important aspect. And actually building a trading algo, we call it, right? Tying your shoes is an algo. Algos are not that complex. People think it's very, involved, and you have to know how to code and all these things. Well, you don't really. First of all, you don't have to know how to code at all. Secondly, you can tell Grok or Chat GPT, whatever, to code for you if you do want to code your algo. So it's all very doable. And having done this for years, I've actually been working with that here and there. I got a video. If you guys want it, I can send it to you. It's free, where I build an algo, I code it, and everything. You can see it done. So when you build an algo to trade, any successful trader is using an algo, whether they know it or not. So what is an algo? An algorithm, it's like a word that's hundreds of years old. It came well before computers, and it's just a method by which, when conditions are met, you make a decision, and you do it the same way every single time. Now, you just heard Larry talk about emotions, right? And this is where the game gets messed up. Markets have a predictability aspect to them when you're looking at the data on the screen. So when I click on the screen, you see all that gobbledygook at the bottom. These data down there actually make trading predictable to a certain degree, better than a coin toss, right? And that's all you really need. And when you can interpret that data in a way that is better than a coin toss, you can extract money from the markets, but you have to do it the same exact way every time. You cannot allow your emotions to become involved. Those emotions are fear and greed. So you see these green arrows, right? Now, this algo is not perfect. These trades will lose. For example, that first one is probably a winner, but this second one is definitely a loser. These two are winners right there. That's a winner. That's two winners right there. It's hard to see, but there's two. That's a winner, although it might be a small winner. That's a big winner, very big winner. So understand, though, that sometimes signals appear and disappear, right? So that doesn't happen all the time. Even when it does happen, some of those win too. It's better than 50-50, but it's not perfect. You will take losses, and it depends on the particular way that I'm trading, but I'm hitting around 70 some odd %. That's like going to a slot machine. machine, right? Giving you $1,000 and I say you can bet $20 at a time and you're going to win 70% of the time, double or nothing. What would you do? You just hit the slot machine all day long because you know 7 out of 10 times you're going to win, right? Why doesn't everybody do this, right? Everybody should just be rich if it's that easy, right? Well, it's not that easy. That's the thing. It takes time to learn. Like I said before, most traders are not profitable for 4 years when you trade in like forex markets, day trading, even swing trading. And a lot of that has to do with, besides understanding the market, learning it, you don't need to know a bunch of math. High school math will do, but it's a psychological issue, right? People, they exit too early. They don't set the trades up right. They gamble. They take trades that are outside the rules. There's like 1,000,001 different problems. And the market has a certain X factor. There's something where the market's not always going to go your way. This is why you win maybe 60 or 70% of the time instead of 100% of the time. You have rules. Why don't you always win? Because the market sometimes just goes against you. It's as simple as that. Sometimes it goes against you because of pure luck. Other times it's other reasons, news events, manipulations, whatever it might be. So that's the framework of what we do. That's what I've been teaching Larry to do. And Larry is one of the few people who has actually done the work and built his algo out of the, I don't know, at this point, I think we got 80 members in there. And there are 4 or 5 of you actually trading. So the 80-20 rule like definitely applies. Out of 80 people in there, there's probably like 15 people who talk regularly. You get another like 30 or 40 people who see all the posts, like they're just not active talking in there. So you get a lot of people who are actually active. Sometimes maybe even 80% of people see it, but then it's like 20% of the active people are actually doing the work. It's pretty cool that you're in the elite of them. And at this time, Larry, you are trading. So now that I've talked a lot about what I do and what we do together, let's get into your questions.
Okay, so I want to better understand EMA.
The moving average, the exponential?
Yeah, the EMA, the 20, 50, 100, and 200. Okay. And what each line and the importance of that line has.
Sure. It's actually a simpler concept than you might think. So let me do a new layout here and we'll just build it out so you can see it. So there's moving average and there's exponential moving average. And you're talking about the exponential, right? So we'll start by talking about the simple moving average. So let's do a new layout. If I can find it, create new layout. We'll call it Larry EMA and we're going to open in a new tab. All right. Is the fresh layout showing up on your tab on the screen?
Yeah, you got a lot of gaps on it, but yes.
Yeah, that's good. It's on the 10-second chart, which I don't trade the 10-second chart. I just use that for data. So let's go ahead and put it to the 30-minute chart, right? So moving average is, first of all, when you have a moving average, there's a period to it, right? So your 10 period, what was the combination of moving averages in which you were interested? Was it the 10, what was it?
No, 20, 50, 100, and 200.
Okay. So the 20, those numbers are your period, right? We'll explain that. So let's bring out I'm going to do simple SMA first, simple moving average. That way we can understand it.
And then
simple one.
Specifically, I'm using the 20, 50, and the 200. I don't look at the 100.
No, well, we're just going to look at the 20 so we can understand what it is. Okay. I'm going to code it yellow. I'm going to make it a little bit thicker. You notice it chases price, right? So price, you'll see here where from here to here, price starts to go down. And then the EMA starts to go down after that. You notice that?
Yeah.
So what it is it's averaging the price going back a certain amount of candles. For you, it's going to be 20. Right now it's 9. So I'm going to change the length to 20. So it's averaging the price going back 20 candles. That's why it takes a while for the moving average to catch up. So when you have this big news move that we had, I think that was like Trump talking on Monday, when it popped up, you'll notice that right away, this started to catch up and eventually it crossed. And then when price isn't doing a whole lot, it just goes right through the middle of price because the average of all these prices stays really consistent through these consolidations. Do you understand what I mean by that?
Yes.
So what it's doing is when you have a 20 period moving average or 20 length, as this is on this system, it's averaging out the price of the prior 20 candles.
Okay.
So as you get new candles and new data, that price is going to change. You get this new candle. Now the average price going back 20 candles is going to go up because you got this new candle and it's going up. And also it's not looking at that 20th candle because that's now a 21st candle, right? You understand that?
Yeah.
So to make this a little more understandable, so at this little tiny red candle, if I go back 20 bars. You can see how it says 20 bars on this right here.
Yeah.
Well, that means that this little tiny red candle that I'm going to explode here, this candle right there, and where that yellow line is an average of all these prices all together, right?
Now, is it taking the price action at open, close, or is it
All together.
so it's taking the full wick?
High to low.
High to low body or high to low wick?
High wick to low wick.
High wick to low wick. Okay.
Right. Now there's weighted moving averages, like it gets more complex, but this, as far as I know, there might be some nuance here that I'm not getting, but I'm pretty sure it's high to low. So a candle is constructed of open, close, high, and low, right? A candle, for example, let's go back here, just look at a candle, any old candle. Like, let's look at this candle right here, this red candle. Well, the open of a red candle is going to be here because it goes down, right? And the close of the candle is right there. Then the next candle starts right at that level. At one point, the price went all the way up to here. That's your high. And at one point, price went all the way down here. That is your low. We understand all these things, right, Larry?
Yes.
So that's your open, close, high, and low. My understanding of the moving average is I don't know whether or not it's weighted. Whether or not it does almost doesn't matter because we're going to use the EMA the same when we trade. But in this case, right here, this yellow line is measuring the price going back all the way 20 candles. Now, when this moves one candle, you get a new candle. This prior candle back here is out of the equation. You see?
Yeah.
So it's no longer using this data. It's now using these 20 candles. And when you get a new candle here, this candle back here is no longer part of that equation, right? So the newer your information, the more accurate that average is going to be. If you're only using 20 candles, are you losing trades over there?
No. Remember when we were talking and I was talking about the gap between USD, between the platforms that I'm on?
Mm-hmm.
I'm flipping out because my price is showing 159. What was it?
Let me give you a word of advice before we even explain all that. It's now 6:45 p.m. EST. You know what the market's going to do? Jack shit.
It's closing.
Yeah, it's jack shit. So
what I'm seeing in the discrepancy with it is that it's moving a lot, but it's not showing up on the one that I need it to.
Mm-hmm.
So then I'm wondering, like, oh my God, thank you, Lord. Sorry, USD/JPY just dropped.
Yeah, it did.
So that's what I'm saying. So like moves like that will happen, but I wouldn't see them. And then I'm looking at the one platform and I'm like, I should be in profit like a lot. And this other one's showing me like it's still in the decisive zone. So I'm sitting here like, why isn't it matching up? And then it's been going on for like 20 or 30 minutes and then it'll catch up. So
remember that there's other people who are going to watch this and they're interested in what you're asking about the EMA. Okay. So let's try to stick with that, but just lock your trade in and not worry so much about it. So because it's going to be hard to divide between a trade at the market close is not going to do jack shit anyway, and trying to learn about EMAs and SMAs. And I know that you were looking for a solution for how to get a little bit more data on when you're going to have a structural bounce. You never talk about that in the background. So I'm going to show you how EMAs work, and then I'm going to show you how you can use that on your trading. Does that sound good?
Yes.
Okay. So the deeper your period. So this is a 20 period EMA. So you're using 20 candles. So you'll notice the EMA moves really fast, right? See how it moves really quick?
Yes.
So if you were to change this to like a 100 EMA, you'll notice it moves a lot more slowly.
Correct.
See? Because you're factoring data from 100 candles ago. So like right now, let's just say where the little bounce is. If I go back 100 candles right there, 100 bars.
Yeah.
So the data that forms this price comes from all of this price movement. You're averaging all that. And if you want to know what a 200 EMA is going to average, so here it is. It's super flat, very, very slow because it's factoring in data that goes back 200 bars. You get it? So all this price data is what it's calculating. So you see that price is going over a wider range. Therefore, it's a lot flatter of a candle. So what people do is, you said it was 20, 50, 100, and 2?
No, it's just 20, 50, and the 200. 20,
50, and 2. So here's the 200.
Okay.
I'm going to code that, say, just fuchsia color. And then we're going to add on 2 more EMAs. So I'm just going to go like this. I'm going to copy, I'm going to paste, and then I'm going to go here and I'm going to change one of these to 100. And I'm going to make it like a light blue color, inputs 100. And then I'm going to take this one, I'm going to change it to 20. I'm going to make it yellow. Okay. So now what you have is a lot of squiggly lines, right? You see all that?
Yes.
Okay. So let me show you how the EMA can be used just by itself for trading. This is like a triple EMA algorithm. It's one of the simplest ones that like everybody uses. Okay. So your 200 EMA is the reddish fuchsia color, the blue is your 100 and your yellow is your 20. Your yellow is your fast, your red is your medium, your fuchsia is your slow. Okay. Now the rules are that to enter a trade, right? It's really simple. Your fast EMA, like let's say you want to go short. Your fast EMA crosses below your medium and then below your slow, and you enter your short. So if that's the case, your conditions are met, and they're met right here, right? Not on the candle, but after the candle after, right? We know how that works in backtesting.
Yeah, on the close.
So you got to, on the close. So you got to use the next candle. And you'd have to figure out how to do your stop losses and your take profits. But clearly that's a darn good trade. If you can catch all that, that's better than a 3-to-1 with this stop loss. Maybe you take a structural stop loss and you get a 1.5 to 1. That's great. 1.3 to 1, right? You put in 1,000, you take out 1,370. So how do you know to get out? What if you don't want to rely on structure, but you want to use the actual EMA crosses to get out? And you know what I mean? That's a way to go too, and you can automate that. So here's how you do it. The exit rule is when your fast EMA, the yellow, crosses above the blue on a short, and you get out right there. You don't let it doesn't have to cross above the red. It doesn't have to be like an entry signal. It only has to cross above the medium. So right there. So what you get is let's just say you do a short at the entry we talked about. I don't know, you have a stop loss above that structure, and your exit condition happened right here, which the price was basically right about here. This price was more or less right here. That's almost a 1-to-1, right? It's an automated trade though. You could tell a computer to do that. Sure, you could have gotten all this profit down here, but once it crossed right there, let's just say price was right here. Unless we could be generous and say it was like here, which is a 1-to-1, almost exactly. So let's go over this again. We'll use another short so we can keep the theme the same, okay? And I'll find one that's successful, because then they don't all work. You'll lose some trades. But here's another one, okay? We're going to go with the short once more, and we'll go with some longs for the newbies out there who don't understand what going short means. You have the yellow, your fast, crosses your blue, which is your medium, crosses your fuchsia, which is your slow, and you're in the trade. And this is a beautiful entry, by the way. So our entry is going to be right. It's not always so beautiful. That's just a nice, lucky entry. You can put your stop loss above structure, however you do it. And, let's just say you're using structural stops. You go back, you see that this is your low right there. I don't know if you can see this.
Yes.
You see that this is your structural low going back a number of times, a number of weeks. So you can have it a little higher than that, right? And then you set up your trade for that to be your exit. And that is that's almost a 4-to-1, right? That's a beautiful trade, right? Well, let's say you want to use the EMA itself to get out instead. Well, what do? So instead of waiting for the yellow to cross the blue to cross the red, you're having your fast cross the medium, cross the slow. You just need fast to cross the medium. And that happens right here, right? It's not as much profit, to be honest, but that's okay. It's profit. It's a 3-to-1, right? And you can automate that. You can literally automate that. It's a very easy thing to do. So we'll go with some long examples. Remember, not all these win. This is a loser trade right here. I think it's a loser trade. I don't know. But we'll see. So this is a winner trade no matter what. So we'll just go with it. For example, you have your fast yellow crossing above your blue, and then your red. So your fast crossing your medium, crossing your slow. So you enter right there, which is up here. Your stop loss could be below structure, however you do it. And then you can have, say, you can use any of this structure as an exit, however you do it, right? It might look just like this, because what I usually do for exits is I look for consolidation where there is a bunch of lows, more or less. Even though it's not a clean consolidation, you have all these lows right there. And I know price wants to go up there to grab liquidity, so I get out before that. So really, realistically, my target would be right about here, usually. Now, obviously, I'm missing out on some profit, but that is a 1.18 to 1. That's a win. Or the other way about it is to use the algo itself, where you can exit when your fast crosses beneath your medium, which is way up here, which is a bit more profit, right? It's like this, and you've gotten yourself a 1.5 to 1, and that's automatable, right? So we'll do one more example of a long. All right, so here's another example of a long. We have here, you can see the yellow. Here it is right here. I don't know if you can see this or not.
Yes.
So there's your yellow crossing up the medium blue, right? And what does it have to do after that?
It's got to cross the slow,
which is the
200.
That's right. So once that crosses, we enter, and then we go long. We have our stop loss wherever you do. We'll just do structure in this case, right? Now, if you're going to trade based on structure, then, I mean, you could use any of these. You could use this one here, that one there. You could go for the gusto, either way, right? Conservatively, this was a pretty long move down. You could split this up. You can manage it however you do it. But conservatively, the trade here is about a 1-to-1. And you just exit right there at structure. Now, if you're going to not use structure, right, and you're just going to use the algo, then, I mean, look, if you think you can design an algo that's going to get all that profit, great. It's not that realistic though, unless you do things differently, right? So that's why I could get all this profit. It's just, no, that's not how it works. Like, so if you let this go and you let the yellow cross below the blue here, the fast cross below the medium, you'll get about this much profit right here, which is a 0.75 to 1, right? But you don't have to think, you don't have to rely on structure, and you can automate that, and that's a 0.75 to 1. So that's how EMAs work in a trading scenario, right?
Yeah, tracking.
So is that more or less answering your questions, or
which one has less noise to it?
The slower.
The 200? Okay.
The 200 is going to have the less noise. Now, there are people who will only use the 200 as part of their methodology. So let me hide let's see, 200 is this one. Okay, so let me hide these. And what they do is they let price cross the EMA, right? So for example, here's this very simple algo. I'm just making it up on the spot, right? When price is in an uptrend, we know how to identify an uptrend. I don't know if you and I have been through this. It's in the Algo Factory basics, right? But an uptrend is higher highs and higher lows. So you're in a downtrend here, right? It's clear downtrend, and you could say this is it. Still in a downtrend, and then you get this sort of consolidation, and then you get a trend violation right here, right? So your downtrend was violated here, where your lower high was broken, and now you have a higher low. And if you can now get a higher low, you're in an uptrend.
I think we lost you there. Oh,
you back?
I guess I was on. Yeah, I'm back. Sorry.
All right. Yeah, we lost you there. So we were talking about a downtrend violation, right? You remember how all this worked?
Mm-hmm. Yeah, I was up to that part.
Okay, so now we have what has begun an uptrend. You have higher highs and higher lows. You know now that you're in an uptrend. Is that correct?
Correct.
Okay, so you're using structure to trade at this point. Is that correct?
Yes.
Okay. Would you like a way to add on to your efficacy?
Yes.
Okay, this is how it's going to be. Here's the way this works. You're officially in an uptrend. So what you can do is, let's delete some of this stuff. We know we're in an uptrend, and we have clear structure right here. See these two pivot points? Very clear structure, right? So there's a couple ways to handle this, but what you can do is you can actually just simply put long trades on at structure as long as price is above and as long as the entry is above the 200. And you don't put it right at structure because, it's not going to work that well that way, but you actually enter right there at structure, right? And there's actually two winners right there. So, if you, like I said, you're not going to put it right at structure, but you can enter your trades that way.
But would you enter that other one because it dropped below the EMA?
This one might, maybe I wouldn't, I might enter it after it popped back above, right? That's another thing that people do. But if you are in an uptrend, you could literally do what you just said instead of doing the thing like I just showed you, because you're using structure. That's why I'm talking about structure, right?
No,
for example, here's structure
the
right
structure,
here.
The structure is matching, but then it dips below the line. So then would you use that? You'd have a different exit strategy then? You just let those trades run?
I'd have to figure out an exit strategy, to be honest with you. I'm not even worried about that right now. My exit strategies tend to be risk to reward based. So it's okay. If I'm going to trade like this, if I'm going to do this kind of thing, the way about it would be to look back at old structure. That's one way to go. And then the other way, just, if I'm going to trade automated in this sense, this kind of more of an automated way to go, I would simply just do I would back test this 200 times. I would get the average risk to reward on these. And then I would just exit at that average.
So that's just like setting the ATR?
Mm-hmm. Yeah. That's literally it'd be ATR based.
Okay. And then you just let it run.
Well, let it run into the ATR, because I use ATR for stop and take profit. So my ATR stop might be 1.2 or whatever. My take profit would probably be 2.8, whatever the number is, whatever that average is, right? So if I back test this, for example, I know you're using structure right now. So I was trying to develop something for you that use structure, which is kind of tricky, but you could see here where it pays off, because there's this very clear, if you look at an uptrend in a very strict sense, you have high, what you really have is, give me a second. So you have your high, low, high, higher low, higher high, higher low, higher high, higher low, right? This might have been the end of the uptrend, to be honest. But if you're looking macro, you're still in that uptrend. right? And then you have a higher high. You could count that little nubbin right there if you wanted to. It's kind of not, this is where the nuance comes in. This is where being a trader, helps. And then you have your higher high, and then you've violated right here. So the uptrend basically ends right about here, right? Well, check this out. Any of these pivot points is usable structure for a new entry, right? Problem is, if you're just going to simply rely on that, you'll lose a lot of trades. Like here, especially in this sort of pullback that we get, that you'll lose some trades. If you're simply relying on this trade, you'll lose one trade. But we have this older structure right there, bounces right off that beautifully, doesn't it? Right. So if you're relying on structure alone, at least if you know you're in an uptrend, that's another story. But here's the problem. You're now dipping below your EMA, right? So if I were to use an EMA, my entry on structure, this just wouldn't be what I do. I'm not comfortable with that personally anyway. What I would do, if I were using an EMA, I were in an uptrend, the EMA was on an upward slope, I would just enter every time price bumps above the EMA, right? Use that pivot as your structure for your stop loss, and then just it's got to be an ATR based exit, right? Like you can use fibs. You can use fibs. What I would do is actually, this is better for fibs in this case. Let's see, what's the cleanest look on this? So there's your extension.
Yeah.
So I would have fib extension. That's your impulse. There's your market impulse. So my fib targets would be the 272 and the 618. That's a 5-to-1. That's beautiful. That's rare. And then you get, like, say your next extension might be here, depending on how you map it, right? Yeah. Clearly in an uptrend, EMA is on an upward slope, and then that's okay. So this is your next extension. Price pulls back. You're going to enter right here, right? Long right there. Maybe your stop is going to be, down here, wherever it is. What you'd have to do is test to see what the best stop is. I'm just eyeballing this. So you add a fib extension onto the prior the prior impulse, and your targets are going to be your 272 and 618, and that's a 6-to-1 if you can make it all the way up there, which this one does. I imagine you probably would maybe take that 272, maybe, I don't know. It's right there lined up with some structure too in the past, so it's I'm just sort of spitballing, but it's a pretty valuable way to do it. But you have to be in an uptrend for that to work, right? And you'll be able to scalp the shit out of it, because you have an upward sloping EMA. You even have like a long as price pops above here. It's still profitable, but the problem is that, you, depending on how long you hold on to it, right? So you need to have a way, like you need to test. You need to go back. You need to test to see how it works, right? You need to test to, to find out what your best stop loss is, what your average take profit is. In this particular case, it might be that, you have another EMA in play that's helping you identify the fact that you're maybe not in the best uptrend, so you can add on like your 100, so like maybe both EMAs have to be in the positive for this to work, right? Like you get a win here, but then when this crosses underneath, now you're not in these trades at all, but then when they're both above, obviously, like you're not getting any trades on the 200 right there, right? So it could also be as simple as like, okay, if the 100 is above the 200, then I could do 100 EMA bounces, but if the 100 is below, I can't touch them.
Are you using anything for, how do I want to ask? Do you use anything for confirmation on that, like a break and retest?
I'm not big on even using the term confirmation. There's rules. In this case, for this one, if it just looking at the way it behaves, I just enter. I wait for the candle to close. So for example, just with our little test algo that we're just literally making up on the spot.
Yeah.
You have 100 below 200, right?
Correct. So you enter.
This one here, this pops up and then it pops back down below. Well, I wouldn't be able to enter until, I could enter right as it does this, which is going to give me a better entry, or I could wait for that candle to close and enter on the next bar market, which is right here.
Yeah, but then that would be, technically you're building a position there instead of just writing out your trade, correct?
Honestly, is building a position better for this algo or not? We don't know. We haven't tested it.
We have to back test it. Exactly.
Yeah, this is where, like, you a lot of times in trading, we identify something that looks really good. We're like, oh, I'm going to get rich and it's the holy grail. I've got the algo I'm going to have the Lambos in 2 years. Like, nah, man, you got to test it. You got to know how it behaves over time. And then after 200 back tests, you have to live test it 100 times to see how you actually trade it when emotions are involved and, stuff like that. So for example, like, right now you're in an uptrend, but you don't see any kind of like any touches until until right about here, right? So let's just say we're doing it where if price goes above the 100, then we enter, and it has to close above the 100 in this case, right? 100's above the 2. Here's the close above 100. We enter the next bar market, which is right here, and we probably would have our stop loss below this most recent structure, right? Well, I mean, how do we know to exit? We don't know. We have to back test to figure out how to exit, right? This might even be a loser trade. Maybe your stop loss was too tight. I wouldn't have it that tight on this. But I mean, it's at least a 1-to-1.
Okay.
And then you have like, 1, 2, 3 more. But, in the end, you're going to start to get riskier and riskier the longer the move goes. So it could be that you do it like this, but what you do is you identify, for example, here's another, just using this exact same algo, here's another trade that fits, right? Right here, where this green candle on the first yellow line crosses above our blue. That's technically an entry, right? So we could actually do our long, right? And we'd have to figure out how to do a good stop loss on it. Prior structures back here, so something down here. So technically that's correct. It's not a 1-to-1. We don't know that yet. We don't know the future. So, I mean, technically this ends up kind of being a shitty trade in a way, but another way about this is that you could use that candle breaking up above next bar market really would be the entry we talked about before. But the other way about it would be to go down. So what is this, a 30-minute time frame? So we can go down to like the 5, and we got to find our, I'm not using my normal multi-time frame chart, so I can't just flash over. So actually have to find it. Just got to look for the yellow bar.
It's going to be way back there. You're on a 30-minute drop to 5.
Yeah, it'll be back there. We'll find it though. There it is. Okay, so now what we have is where if you want to do the confirmation play, then you have your conditions for a trade, right?
Mm-hmm.
And then you can look for like some kind of a pullback and then buy the pullback. And then you just get like a tighter stop on it. Because higher time frame, you have good conditions for a trade. So you could go down to the 5-minute, maybe use another methodology. It might be SMIs or something, right? Like for example, I could add on SMI, which me, that's my weapon of choice.
Yeah.
So, you could look for a pullback to oversold and then just use that as your entry. So a 5-minute pullback to oversold, let it flip up so you won't get right there, but you get right here. Put your stop below the most recent structure. Now you're sitting at like a, I mean, you don't know how good it's going to go, but you're sitting at like a 1.75 to 1. Okay. So you could merely like you could use that algo to identify entry condition. That means you're going to be in a bullish moment no matter what. And then you can roll down to like a 5-minute chart, get granular, look for a pullback on SMI, use that as your entry, use that structure as your shop, and then you end up getting a lot more money that way and a lot more turns.
Okay.
So, I mean, that's just...
I appreciate it.
This is how, I mean, look, I'm just going to say to anybody watching this, I know what the fuck I'm doing. Like, I literally just built this right now for you, right? And it's a pretty darn good algo. I haven't looked at EMAs for like, I don't know how many years. So it's, it's something that I know my stuff with this. Like, other people we watch, they just know their stuff on other stuff. And I just kind of sit there on our podcast and I sort of stay in my lane. This is my lane.
Yep.
So yeah, I would do to sort of review, like we'll do another example. We'll jump up to the 30 and we'll come to modern times. So I don't have to just go back forever. So let's make the algo this on the 30-minute chart, and you could translate this to like higher time frames and stuff, right? So on the 30-minute chart, we look for price to close below, or you could even just bounce below the 100 EMA. And the 100 so condition 1, 100 EMA has to be above 200 EMA, right? Condition 1, okay? Condition 2, price bounces, whether it closes below or simply dips and bounces back up as soon as we get a close above the 100. So in this case, the close above the 100 in this case is right here, right? This bar goes up, closes. So your next, like your time when your condition is met is this candle right here, this longer green candle, but it's at the beginning of that candle, right?
Yeah.
So that, if you look at it, is going to be right at 8 a.m. my time. So 9 a.m. You're central, right?
Yes.
So for you, 9 central, for me, 8 central. So now when that happens, when that bar closes and that bar opens right at 8 a.m. my time, I jump down to the 5-minute, and that's right here, right there. So I can literally enter this trade if I care to. Now I could use structure based on a prior SMI flip that dipped right here. So this could be my structure right here if I wanted to enter that trade, and I could have a stop loss below that. If I want to play the confirmation game, then that would be like here. And that's a losing trade.
Okay.
Right. So, you're going to have winners, you're going to have losers, but understand that as long as those conditions are still met afterwards and you're having bounced and moved above, you could probably take the next confirmation, which is right here. So you lose this trade, right? You probably lose this one because what you're doing. I mean, I don't know. Technically you could win that one if you scalp it, really.
Yeah.
So if you dump down to here, you enter right here. Now the flip is actually here. It's not right at that candle. It's this candle. So you're really really going to end at the following candle after that, which is right here. Your stop loss is going to be, down below the spread and all that. So, I mean, it's almost a 1-to-1, and that's with a pretty deep stop for a 5-minute trade. That's a 1-to-1 right there. Like, I mean, there's room, I could have a lot of room in here to make it better than a 1-to-1 by far. So literally for scalping purposes, you're good to go. Now, what you could do to build a position on this is if the conditions are still met, then you could scalp and take half the money off, leave half the money on. If you lose, you lose. That's fine. Like you could scalp and you could put stop to entry so that you're in permanent profit, right? Now, if that loses, that's fine, which that would happen here. You'd stop out, you got 50% profit, but now you have another bounce in the 5-minute. Conditions, I believe, are still met. We'll have to double check that. And then
not for long, it's not above.
Well, that's on the 5-minute where the conditions are on the 30-minute.
Oh, yeah, that's right. You're right.
So we would have quite possibly, I have to double check, but quite possibly another trade, your stop loss would be down here somewhere. And then, you can let it run. And then let's just say you're using this structure. So you take half your profit off right there. Stop goes to entry. You leave it on though. If it goes down to entry, you stopped out, but it won't in this case. And then you just continue every time that condition is met and you get another bounce, you're building here. You add here, right? Now you got another trade on top of it. Now this could be a tough one because you should be able to add on in time here because it's 2 candles out. If you add right at the right time, then you get this trade here, right?
Yeah.
And then, but at some point you're going to have to keep an eye on that 30-minute because then when the condition ends, then of course you need to, your exit strategy, I think, should be that when the condition ends, you're out.
Okay.
And your condition could be a 30-minute SMI top and flip, which is right here,
Yeah.
that could be your condition. So, I mean, this is a pretty good algo. Dude, SMIs, and this is SMA, this is SMA. This is the simple moving average. So you asked about EMAs, right?
Yeah.
They work the same exact way, but an EMA puts more weight on recent candles.
Okay.
That's the only difference. So I've actually tested SMA versus EMA on algos, and it actually kind of depends like what your algo is like, which one works better. So if I were you and I were testing this or any kind of EMA, SMA algo, I would test both EMA and SMA.
I'm going to have to test both. I got to run. I'm getting called by work, so I'm going to cut you short. All right.
No worries.
I appreciate it. You gave me something to back test.
Yeah. Have fun.
All right.
Ciao.